Mutual funds. You have heard this word hundreds of times in your life. But what exactly are they? How do they work? And why do so many people invest in them? In this video, we will understand mutual funds from scratch with examples and visuals. In this video, we will cover what is a mutual fund, why do people invest in mutual funds, how do mutual funds actually work, why mutual funds are better than FDs, and last we will see myths. What is a mutual fund? Think of a mutual fund like a cricket team. You and your friends pool your money to buy the IPL team together. Similarly, investors pool money and a professional fund manager invests that pooled money into stocks, bonds, gold, etc. Here you can see on the left side we have investors like you and me. Each investor contributes a small amount of money. All this money is pooled together into a single basket called a mutual fund. For example, here I have written Motilal Oswal Midcap Fund. Now, this fund is managed by a fund manager. Their job is to decide where to invest this pooled money. The fund manager take this pool money and invest it across different companies like I have shown Geo, Adani, TCS, Zomato to create a diversified portfolio. So instead of you buying one stock directly, your money gets spread across many companies through the mutual fund. That's the power of diversification. This reduces risk factor. Why do people invest in mutual funds? There are three major reasons why investors choose mutual funds. Simplicity. Even with 100 rupees, you can start investing in a mutual fund. Diversification. Mutual fund invest in multiple companies. Professional management. Fund manager manages the mutual fund. How do mutual funds actually work? When you invest, your money is pooled with other investors. The fund manager invests that pooled money into different companies. Then you receive fund units, and the price per unit is called NAV, net asset value. Here you can see after fund manager investing its money in companies, the mutual fund returns units to investors based on the investment amount, and these units will be calculated with the help of net asset value. Here you can see the current NAV is 115. Consider you are doing monthly SIP of 1000 rupees. Then you will get 8.6 units in return. Why mutual funds are better than FDs? FDs are safe but give limited returns, around 6 to 7%. But mutual funds, especially equity ones, can deliver 12 to 15% over the long term. Here you can see the comparison chart between FDs and mutual funds and their returns over the years. By this, we can conclude mutual funds are great for long term investment. Myths. Let's clear up a few common myths that Indians believe about mutual funds. Mutual funds are for the rich. In reality, we can start with rupees 100 SIP. Mutual funds are gambling. No, they are regulated and diversified by the fund manager. You can lose everything. No, only if you panic and sell in short term, you will lose everything. Here are some real mutual funds from different categories. SBI Blue Chip Fund, Kotak Emerging Equity Fund, HDFC Balanced Advantage Fund, ICICI Prudential Short Term Fund. We will later discuss more about large cap, mid cap, small cap, hybrid, debt in this series. The key takeaways from this video are mutual funds are nothing but pooled investment, diversification reduces risk, long term compounding builds wealth, SIPs make investing easy. Mutual funds are not magic, but they are simple, smart way to grow your wealth if you stay consistent and have patience for long term.